In order to planning for the future, managers must oversee day-to-day activities to keep organization functions smoothly. The day-to-day activities are employee work assignments like generating sales report, uh, income statements, and all other things. Routine problem solvings, like if there is a need to reinstall the Windows in the computer, the printer cartridge is finished, it's not working properly, replacing the printers like that. Conflict resolution, like if there is a dispute between between the managers and managers, employees and employees, employers and manager, this kind of day-to-day activities. And the last one is effective communication. So that means that the information that is coming from top management to middle management to the employees, they are communicated through effective channel so that there is no noise between them. Plus, there should not be any dual command of chain. So it means an employee must not have on its you can say that two authorities on it. So there should be one order, or there should be one authority on it. The next one is regarding the controlling function. The control function basically ensures the plans are being followed. So the important tool for controlling function is feedback, which are done in the form of performance reports that compares the actual results with the budgeted one. So through that control function or feedback, you basically ensure that you are on the right track. Okay, the planning and controlling cycle, which is the work of management, it is a continuous loop, so which shows that once the plans are formulated, they must be implemented and they must be compared with the actual results. So in some cases, new information may result in altering the plans before the cycle is repeated. For example, if there is a new short-term plan, then this cycle is repeated. So if in controlling function here, if the actual results are not according to the planned one, then corrective actions must be taken and this loop continues. Okay, so now we are going towards our question at the start, in which we talk about we're going to identify the differences and similarities between financial and managerial accounting. So let's further explore this. So there are several key differences between managerial accounting and financial accounting. Number one is based on users. So financial accounting reports are prepared for external parties, whereas managerial accounting reports are prepared for internal users. And what are the internal users? Basically managers. The second one is time focused. In financial accounting, the focus is on historical, what we have done during the year, what is the position of the company for on a specified date, whereas the managerial accounting, it emphasis on future, which shows us if we sell, for example, 100 bikes, what will be our profit what will be our extra cost, and if we increase our fixed cost, what it will going to affect our net profit or net operating profit as well. The third point is the verifiability versus relevance. So financial accounting data should be objective and verifiable, which means verifiable through external party like auditors. So they verify the data that up to the best knowledge of the accountants, sorry, auditors, the statements are produced in a good faith and all that stuff. But the emphasis of the managerial accounting is based on relevance. So the crux is that the managerial accountant focus on providing relevant data even if it is not completely objective and verifiable, because you have an opportunity and you does not need any uh, uh, verifiability from auditors or something. You just want to see that if we want to sell more like 1,000 pieces of an article, what should be our profit? So in that case, we do not need to go to the auditor and verify the facts and figures and all about that. And the fourth one is, which is precision. The financial accountant is basically focuses on precision when reporting to the authorities. Whereas the managerial accounting, it aids decisions by providing reasonable estimates and more quickly rather than waiting for precise data later. Which means the managerial accounting, it focuses on timeliness. Subject, the primary focus is the whole organization in financial accounting. Whereas in managerial accounting, it focuses on the segments of an organization. So examples of segments include like product lines, sales territories, divisions, departments, like what segment we need to sell, or what segment we should acquire, what products we should buy or make our own, or outsource to the third party, this kind of stuff. The sixth difference between managerial and financial accounting is the standard, generally accepted accounting principle. So it is required by law for the financial accounting to follow GAAP standard, sorry, whereas managerial accounting, it need not follow GAAP or any prescribed format. So the requirements of the financial accounting is that you have to produce reports for external purposes, and it is mandatory requirement for external reports. Whereas in managerial accounting, there is no such kind of requirement, and it's not mandatory that you are publishing a report for the external purposes, or you are required to produce report in management accounting. So as I mentioned in our uh, previous slides, that I'm going to show you a video regarding why there is a need of managerial accounting. So the next part of this video is after this slide, which shows the importance of managerial accounting, and it also compare the financial and managerial accounting perspective. So let's see that video.
To satisfy the customer's demand for quality, flexibility, timely delivery, and value. Managerial accounting plays a key role in achieving these goals. Managerial accounting developed to provide useful information to management and other internal decision makers. Using both financial and non-financial information, managerial accounting provides timely data, including estimates and projections, that supports planning and decision-making. The importance of this information has increased as competition has intensified. As a result, corporations have come to rely more heavily on managerial accountants. To meet management's expectations, managerial accountants must now develop an in-depth understanding of all aspects of a business. Become a data hub for the company. Apply analytical skills to spot trends and provide forecasts. And provide insightful advice to top management. In short, managerial accountants today and in the future must be more than accomplished technicians. They must be agents of change.
Okay, so that's it. This is the end of our lecture 1. If you have any question, I encourage you to write on a Blackboard discussion forum or in our WeChat group. So see you in lecture 2. Until then, take care. Bye-bye.